Hello, everyone. Today on the Final Bar, I'm talking with T.G. Watkins of Simpler Trading here in our studio in Redmond, Washington. Should be a lot of fun. We had T.G. in earlier this year, talked about the market conditions, the skepticism about further upside, which we both shared. What's changed in his toolkit to confirm this uptrend in growth stocks? Growth in the leadership seat today with the three FANG sectors at the top of the return list. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thank you so much for joining us every weekday after the close as we break down the activity in the markets using the power of the StockCharts platform. The StockCharts platform was started over 20 years ago as a way to empower investors to better understand the world around them using the language of technical analysis. I would argue out of all the languages in finance that you can become fluent in, this is probably the most important one because it is grounded in market participation, in market behavior, or as I call my own firm, market misbehavior, and how we often make poor decisions with our capital. It's all about analyzing fear and greed, euphoria, desperation, all of those emotional drivers through analysis of price action. We have a lot of charts that we can cover today. A great guest today, T.G. Watkins. It's always fun to have a guest here in the studio. We'll talk with him in our interview set here in a short while, see what sort of charts are top of mind for him. Let's recap the markets right now and focus on how the charts have evolved from yesterday's close to today's close in our market recap. As I sort of alluded to, nice move higher, particularly for the growth areas of the market. We've talked about sort of the concerns about the lack of participation in growth stocks really over the last week, right? You've seen some of these leadership names like Alphabet and Microsoft and Apple take a bit of a breather, and it opens up the door to all sorts of questions on the sustainability of the trend that we've seen year to date. Does that continue? Now that we're in the seasonally weakest month of the year here in June. June's actually been pretty strong so far, but what happened today? The S&P finished up about 1/3%, really 0.4%. Just above 4380. Now, a lot of that came in the last 30 minutes. You saw a nice upswing for the S&P and the NASDAQ to close near the highs of the day. Not too long ago, it was actually floundering there about 10 points lower. So a nice rally going into the close. The Dow essentially flat from yesterday's close, just below 34,000. And the NASDAQ composite leading the way higher, up about a full percent to 13,630. Mid caps and small caps both underperforming. Worth noting that the small cap index is down 1%. Now, a lot of times when people think about small caps as a sign of risk on or risk off, totally fair. And if you look over time, that's a reasonable expectation of small caps tend to be higher beta, higher risk. And as a result, usually tend to lead the markets in the bull phase and lag the markets in a down phase. However, you have to remember the sector allocations, right? So the small cap index, much lower weighting in things like technology and consumer discretionary communication services versus the mega cap weight that you have. So that's why when the FANG sectors are leading, small caps most likely are struggling on a relative basis on a day like that. The VIX keeps going lower. We're at a 12 handle. We have not seen a 12 point anything in quite some time. Below 13 is pretty outrageous. Below 15 is incredibly low relative to historical standards. So we are at all-time lows of volatility, and that's not totally true, but certainly long-term lows for volatility. This is a low volatility bull market phase. Very interested to see if and when that changes. It will change at some point, but as we say many times, that day is not today. Let's look at the interest rate environment. Bonds overall moving lower today, so we continue to see a move away from bonds. The TLT, which is a long Treasury ETF, down about 1.2%, just above 102.30. The yield curve overall moving higher, and actually the short-term yields remained fairly steady. Everything else kind of pushed higher to a pretty significant degree. 10-year yields currently around 3.8%, 30-year yields around 3.87, and the 5-year yield back above 4% to 4.05. And if you're wondering why these are quoted in teens and not, looks like the decimal point is 1 over, that is historically how the SIBO reports yields. I have this story in my head that I feel like I was told at some point that on the trading floor it focused on the decimal counts that they were looking at, sort of the pips, like the lowest change in the decimal. So that's how it was quoted on the floor, and I think that's just a legacy sort of quoting system. But if you know the answer as to why it's quoted in teens and not in single digits, let me know in the comments. But I'm pretty sure that's the story I remember from going to the exchanges in Chicago back when they had floors that were active. Now look at the commodity space. The DBC was down about 1.9%. Not a great day for commodities, particularly for energy, and crude oil prices came down quite a bit. The energy sector has been struggling, and today did not help. Now, earlier this week, we talked about those cyclical sectors starting to emerge. Industrials, we talked about. We actually focused a little bit on the industrial sector yesterday. Today, we have to tell you that energy actually rotating back to the downside. Some of those other sectors like financial struggling quite a bit today as well. Gold and silver prices both in the red, and I think that's a trend that we've been observing and we've been reporting on for a little while now. We'll look at the chart of the GLD here in a few moments. You can see what's happened as that area of the market has been rolling over. Basically, the trend is broken. Support is not holding. Certainly seems to be in a confirmed downtrend. Cryptocurrency is kind of taking a breather. We call this a digestion day. I haven't used that sort of word in a little while, but basically a digestion day is after you have a big move. Think of it as like the big Thanksgiving meal. Then you need to kind of sit back and let it all settle in. This is what a day like today is for something like Ethereum and Bitcoin. These have had really strong runs to the upside. Bitcoin now above 30,000, testing 31,000 or nearby. That's the swing high from back in April, if I remember right. We'll look at that chart here in a moment. If we can, Ether as well. So most cryptocurrencies actually pretty low percent changes, kind of digesting the big move that we saw previously. I would argue the chart of Bitcoin and Ethereum pretty constructive here after bouncing off of key support levels. Finally, in terms of sectors, as I mentioned, it was the FANG sectors at the top of the list. The XLY, the XLK, the XLC, familiar pattern for 2023, but not so common in the last week or two as you've seen the leadership areas of the market take a bit of a pause. Today, potentially sort of pushing back higher, resuming that uptrend. And some of the names that we might show, like Netflix, breaking out just very, very nicely. On the downside, defensive sector, real estate at the bottom, 1.4% down. Energy down 1.3%, then financials, utilities, industrials, both down about 0.7%, a little more than that. Let's go to a chart of the S&P 500, our daily chart, and see what happened today. So a bit of a bounce higher. So we had 3 straight down closes. Today we sort of changed that pattern. We closed back to the upside. So I guess we won't be closing lower forever. There has to be a bounce higher. And so the question with any of these sorts of days or how does the larger trend start to change? And I would say at this point, still too early to say if this is the beginning of some sort of short-term bottoming pattern before rotation higher, or if this is just a bounce within a downtrend. What you have to remember, there's a fractal nature to the markets. And what that means is if you look at hourly charts or 5-minute charts, or in a very liquid thing like a future or an Apple or something like that, a heavily traded ETF, you'll see that they're even down on a 1-minute chart. There's that fractal nature, right? There will be the trend, and then there will be the noise, the sort of the little price movements that make up that larger trend. So I'd say at this point, the larger theme is still a market coming out of overbought conditions, a market with a question mark as to what sort of drawdown we may get. This could be the bottom. We could bottom out at 43.50 and rotate higher. I would guess that that's probably not the end of this sort of pullback phase that we've experienced so far. And to me, 4,300 to 4,325 remains that main level to watch. And as long as we hold above there, this is just a short-term pullback within the context of a raging uptrend. We start to break 4,300. That's when I think a red flag raises up for me. That's where I have the alert set to really revisit downside and make sure that you have good downside protection. T.G. Watkins, our guest today, has spent a lot of time flying airplanes, much more than I have, and he will probably tell you when things are going well, when you're flying straight and level, that's the time to figure out your emergency plan, not when the engine cuts out and you're going straight down. That's not the time to dig out your map, dig out your sectional, and see where the closest airport might be. So the S&P overall hanging in there, nice bounce higher, but still I would stay within, I would say, in a sort of a pullback mode. Let's look at 2 other macro charts, and we'll look at some individual stocks just to finish off our market recap. I want to look at the chart of gold. We've highlighted this chart here a couple times here in the last couple weeks, and I think things have really started to change for the negative on the chart of gold. The GLD from November of last year really through April was a story of a pretty consistent uptrend. I have this trend channel that I drew with the higher lows and higher highs, sort of this nice progression. And then what's cool about a trend channel like that is it gives you a pretty good visual context of what this trend, how it's playing out. And what you're looking for is when something's different, right? What we call a change of character. When are you seeing something different? And what I mean by different is it breaks out of that channel. Either breaks to the upside, which means the trend is going vertical. It's really an exponential rise, some parabolic rise because of some new catalyst that's causing a change in the trend. or we break down. And that's really what's happened here. And look at all the things that have happened just in the last 4 to 6 weeks. We've broken down through the 50-day moving average. We've broken down through the trend line connecting the lows in November of last year and March of this year. We hit 180, and we actually bounced off of there a couple times. That was interesting because it was pretty close to the high in January. That sort of lined up pretty well with that level. So that was a level to watch. We've now broken that in the last week. So the next level down is the first Fibonacci retracement level, just below 176. So, by my take, this is a chart no longer in an uptrend. It's now in a downtrend. And I think one of the main ways I would characterize that is because the momentum has gotten so negative. We're underperforming the S&P. This is a chart that, if nothing else, when you see the relative strength rotate lower, it just tells you by trading this chart, by owning a stock or an ETF or anything like this, you are basically sacrificing your capability of outperforming the market right now. In general, I like to look for things where the relative strength is improving. Ideally, it has been underperforming and starts to improve. That's not what we've seen here. We've seen an area of the market now that had been performing quite well on a relative basis, and now that is starting to suffer. Bitcoin, we've talked about a lot of times. There have been stretches on the final bar where we haven't talked a lot about cryptos. There are times when they are very much relevant because there are significant moves, and I think this is one of those times. We've been tracking this rotation in Bitcoin, sort of this head and shoulders topping pattern that occurred in March, April, and May. We broke down through that neckline and found support right below 25,000, and that's important because it's a Fibonacci level. It's a 38.2% retracement of the way back down from the April 23 high to the November 22 low. We found support right there. Look how well it lines up with that level and then rotating higher. We're now back over the last couple days, back above the 50-day moving average, and now we're testing the previous swing highs. 30,000 is a big round number. If you look back in the history of Bitcoin, you will find more often than not, this thing tends to find support and resistance at big round numbers. Just look back at what happened when it broke through 20,000 and then pulled right back and tested support right about at that same level at the 200-day before making a new swing high and a new high for the year. Now we're testing those new highs. I think the question for Bitcoin, is there enough upside momentum, enough interest to pushing this price above 31,000? For now, it certainly appears that that is the path of least resistance, but resistance is the word, and I'd feel much better with this getting above 31,000 and staying there. I think that's an important level in play as it becomes overbought for the first time since mid-April. Just to wrap up our market recap, let's look at some individual stocks that are sort of on the move. We've talked about the FANG stocks so many times in different ways. I just want to highlight Amazon, one of the better stocks in the S&P 500 today. The XLY, one of the leading sectors. And when Amazon and Tesla are in strong uptrends, which they are, those are the two biggest weights in the XLY. And as a result, the consumer discretionary sector as a whole is going to look pretty strong. Amazon made a new high for the year today, closing right above 130. That's up another 4.3% from yesterday's close. So over the last couple weeks, sort of rallied up to 125, stalled out, and maybe we're breaking out of this range and going higher. Love to see if the momentum can continue higher as we see additional demand pushing price to the upside. But it's worth noting we're back above the 200-day moving average. We're back above the 50-day. We're making new swing highs. This is definitely a chart in an uptrend. It's not just the Amazons of the world that are in uptrends. This is PANW, Palo Alto Networks. If you're not familiar with that, a technology stock. It's in the telecom equipment group as how we bucket it. What's interesting about this chart to me is not just the fact that it's going higher, it's the fact that the relative strength is so impressive, right? A number of people on StockCharts TV, particularly Grayson Rose, when we did our favorite indicator, which was an episode of this show a couple weeks ago, he focused on relative strength. I think that is a brilliant move. A number of our StockCharts contributors focus on relative strength. That is a really important part of the technical toolkit, in my opinion, because it shows you what's doing better than average. And PANW, for now, certainly doing so by the fact that the relative strength is breaking higher, making a new 12-month relative high today. Finally, other areas of strength, healthcare. Healthcare has been a sector that's been struggling on a relative basis, but pockets of the healthcare sector really starting to improve. Look at how HCA recently made a higher low around 260. It undercut its 50-day moving average, which was a bit of a question mark for me, but found its footing, now rotating higher and making a new high. Look at how the RSI pulled back to just below 40 and then started to push back to the upside. Similar name like that would be something like Merck, obviously in the pharmaceutical space, maybe a little earlier than HCA. You saw the rotation higher, the new highs. Merck just recently making a higher low. So Charles Dow Theory 101, higher highs and higher lows. We had a new 52-week high in early May. We've now pulled back and potentially made a higher low in early June. Are we now back heading to retest the highs? That potentially is sort of that fat pitch chart. Long-term uptrend, short-term pullback, a lot of times can be not an ideal place to get in. If you're looking for areas of the market that are struggling, just look at financials and energy, and I'm sure your cup will runneth over with opportunities of stocks that are struggling to gain their footings. Think about why PANW is such an attractive chart, why Amazon's such an attractive chart, making higher highs and higher lows. Flip that over and you get a chart like Huntington Bank shares, right? A new low in March, rallying higher to a lower high in April, making a new low in May. We make a lower high in June, and this pattern of lower highs and lower lows is what's truly concerning. On its most recent attempt to regain the April high, the RSI stalled out just above 60. Overall, this is a chart in a downtrend until proven otherwise. Folks, we're going to be back here in a moment with T.G. Watkins of Simpler Trading here in our interview set. We'll see you in a minute. All right, so we're back here with T.G. Watkins of Simpler Trading here in a moment. Before we get there, I want to remind you of a couple quick things coming up. First off, we're going to be doing a special webcast next Tuesday, the 27th, called the Market Top Checklist Revisited. Back in 2021, I did a webcast called the Market Top Checklist, focused on some charts, some technical indicators I would be watching to gauge when that uptrend may have been exhausted. It handled it very well. We had a great way of navigating the end of 21 into 22 because of some of those metrics that we were following. I'm going to dig out that checklist, update it for 2023, and we'll answer the question together. Is it indicating upside exhaustion for this market? You can sign up for that free event coming up next Tuesday at marketmisbehavior.com/top, T-O-P. Also, just to let you know, we love hearing from you. Feedback on our show, feedback on our opening music, but especially your questions. What are you running into as you are analyzing the charts, as you are analyzing the technical indicators using the StockCharts platform? Our email is thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. And on YouTube, just put a comment below the video you're watching. We love to hear from you. Hope to answer your question on our next mailbag on Friday's show. I want to welcome on today's guest, T.G. Watkins. T.G.'s the Director of Stocks at Simpler Trading here in the Seattle area. Welcome back to the StockCharts TV studio.
Great. Thanks, Dave. Appreciate it.
It's good to see you again. So
always.
Last time we were talking about the conditions in the market and the likelihood of the market continuing higher from there. Certainly has, right? We've seen continued upside for the S&P, for the NASDAQ. What are you seeing as you're looking around you as an analyst today?
Well, yeah, the markets finally broke out, and we are actually starting to see broader participation. This was the number one thing that last time I was here, we were talking about things. We were seeing things basically degrade and disintegrate from the inside, and we thought, okay, well, the breadth is starting to fall apart and collapse. When is that going to pull the rest of the market down? Well, instead of that happening, it all turned around and finally started going up. And what we're really happy to see is instead of just the 5 or 7 names that are really carrying the market, we really started to see everything fan out and starting to see that broader support. So what I wanted to do is kind of bring up a couple of charts from the last time that we were here talking, because last time we were like, hey, I'm seeing some things that if this continues with the negative breadth, then we're going to see the market roll over. And a couple weeks later, it all changed. And so as a trader, I think this is actually a really good opportunity to take a lesson and say, here is the information I have right now, and this is my thoughts and my narrative based on that. But if it changes, we need to have our minds open enough that we can actually look at that with a clear mind and go the other direction if that's what the new data suggests.
Let's go ahead and follow the evidence, right? Yeah, if it changes. We're looking at your chart of the Russell 2000 ETF, the IWM. Talk us through this one if you could.
Right. So the last time I was here with you guys, we did talk about this. The big arrows are pointing out where price ran up into the underside of a downtrending daily 50. That's that purple line. And you can see it did roll over. And the Moxie indicator, which is my indicator down there, was also below 0. And you can see everything rolled over. But then right as price should have fallen apart, or we would have expected price to fall apart, it hit that double bottom and decided it wanted to go up from there. And then it took a little bit of some shake and bake. You can see there was some flagging. And then here is the point at which we really started to see some definitive differences. Instead of getting rejected by the daily 50, it actually got over the daily 50 and then tested the daily 50 to go up. And that's actually where you see the green arrow. So not only did price test the daily 50 at the same time, the Moxie indicator also fired green at the same time. I circled that, and you can see the other 2 circles. Each time that the daily Moxie indicator fired green, we had a positive move. So the Moxie indicator is right on time as far as its timing goes. It just took a few weeks for it all to kind of get hammered out.
It's such a great lesson, and I love that point about focusing on the evidence. I think one of the benefits to charting and technical analysis, you have an idea of where things are headed, you have your position, but then a clear indication of when things are changing. We started to see that here recently. Let's look at a chart of the S&P if we could, because we talked about how the breadth conditions really were so underwhelming, right? And it felt like, how high can the market go without breadth support? How has that picture changed now?
Yeah, well, so this is the S&P. Anybody else out there can also look up the Dow. I think the Dow is a really good example from mid-April. I mean, really, April 14th, April 15th. You look at that, that is when breadth peaked, and that's also when the Dow peaked. You can just see that the Dow is a good representation of how kind of the internals looked. But from here, you can see that normally when the internals peak and come down, it brings the market down with it because, well, the majority of stocks are starting to move down. And this was an interesting phenomenon that we saw mid-April, that breadth peaked. The market did also peak, but it didn't go down. It was going sideways. And yes, it was being buoyed by the large 5 or 7 stocks.
Right.
But we were wondering, is this going to be a problem? Is it going to tear those down? And is this a blow off top? Is this the end of this upcycle? But sure enough, we finally saw, I think it actually happened with the debt ceiling crisis kind of getting resolved. That seemed to be the trigger.
Yep.
And then we saw just everything light on fire. And you can see the purple arrow right there. This is the number of stocks over their 20-day SMA, just straight up. And that was conviction. And across the board, you just look around and everything just lit up at that moment.
And it's when the S&P, of course, itself at the end of May starts to break out of that consolidation phase that we had. So similar to sort of a consolidation, sort of a pullback, but instead of being a price correction, it's sort of a time correction, right? And then we broke out from there.
As far as the SPY goes, it was a time correction. But what I would say is that the rotation down, the cycle actually happened underneath the surface. You know, the SPY masked it. You know, it was just going sideways. But if you look at the Dow was kind of going down.
Right.
If you look at the IWM, it pulled back and then went sideways. But underneath the surface, everything was cycling down and then popped back up. So there was a bit of a correction underneath the surface, and the indexes were masking it.
So I'd love to talk about some individual names here in a second, but while we're talking about the S&P, now that we've continued to push higher, now 4,400 is in play, people are now looking left on the chart to 4,600, all-time highs at 4,800. Where do we go from here? We're in what is usually a pretty quiet time for the markets, usually a rough time for markets, June, July, August, into September. How do you see this sort of period playing out? Are you still seeing signs to be constructive here in late June?
Yeah, I'm generally still bullish. Now that all this has happened and we're seeing the IWM, you know, it had a year to go sideways and now it's up. And then we'll look on the next slide to kind of show you what I'm seeing in the rest of the market. I think we're bullish. You know, it's obviously kind of hard to argue that. So really at this point, what I'm saying is, we see that things are overbought. We saw that the S&P definitely reached some areas. It went outside of its third Keltner channel. The IWM went all the way to its third Keltner channel. All these things that just say, yes, we're overbought. The put-call ratio is super low. And so we just need to let everything chill out, relax, cycle back down, just kind of like we saw that breadth. We need to see things kind of come back down. But I'm going to be looking for strength. I'm not so concerned about the market falling apart anymore. I'm just looking and just saying, hey, let's sit on our hands until things kind of work its way back down, until all the indicators kind of get refreshed. And if we start seeing more green shoots start to come alive, maybe it takes a week, maybe it takes 5 weeks, whatever it takes. But I would be looking for the pullbacks to come into support and finding out where those new low buys are going to be.
That's a great point. You could argue if you're bullish here, one of the best things to see would be a meaningful pull, or at least some sort of pullback to reset this uptrend and go higher.
It could be a pullback, it could be a flag. I mean, we just saw that a few months ago, and that's why, you know, we are starting to see some names finally come down. I'm even thinking of Palantir. Palantir was right up there, and it definitely took a while for it to, you know, people were thinking, oh, maybe it's just going to go sideways. Well, we are starting to see it pull back a little bit, but maybe it could find a range and actually just kind of go sideways within that range.
One of the stocks you wanted to talk about was Squarespace, SQSP. Can you talk us through this one, what it's telling you now?
This is, I just thought this was a really good chart that is, I feel, indicative of what I am seeing out there. I like to trade the growth stocks. You know, they're fun, they're bubbly, but they have been an absolute nightmare for the last 2 years. I mean, we've been in a bear market. The interest rates have been going up, and you know, all these kind of stocks have to get repriced and then just figure out what they're doing. So what we've really seen is since basically 2021, a lot of stocks IPO'd, like Squarespace, or if they were riding around for 2020, they all then got smashed in 2021 and 2022. And what we can see is initially there was a downtrend, and that's a pretty easy thing to trade. But then what got really difficult is in 2022, a lot of these stocks, a ton of stocks out there, you can even look at the ARK ETFs as an example.
Yep.
They stopped going down, but they weren't quite going up. They had some moves, but then they give it back and they have another move and give it back. And you're trying to think, okay, what is going on here? And now it's becoming clear that really they were basing. And they took about a year, just like the IWM took a year, of going sideways. And if they don't fall apart, then where are we going to go next? Most likely up. And so Squarespace is a really good example of that. If you look at the monthly chart on the left, you can see that price got over the monthly 10 SMA, which is the blue line.
Yep.
And then it tested the blue line to actually go up. And now it looks like it's kind of flagging sideways into that blue line again.
Yeah.
So even on a monthly basis, we're starting to see a change of trend. I kind of heard you talking about that earlier today about gold.
Yeah.
But we're seeing the same thing here to the upside. And if you look at the weekly chart, well, you have the 8 and 21 EMAs, they're now positive.
Yeah.
And then we have price get over the weekly 50. And we have the Moxie indicator fire all at the same time. So the Moxie indicator has really been doing a great job for a lot of these stocks that I'm seeing about kind of a new batch of bullish, start from scratch kind of stocks to where it's firing right as price crosses the 50 SMA.
It's impressive how some of these names, I feel like you sort of mentally wrote them off, right, for quite some time now, really starting to emerge once again.
Palantir is a great example. I mean, there's so many names that are starting to do like this. ON. I mean, just a ton. IonQ.
How could we talk just briefly about some of the sectors that have not been doing well, particularly things like energy, financials? I mentioned Huntington Banks, Chevron, others just kind of rotating lower. What would you need to see from stocks like that to see them as a long opportunity, to see them as a good upside opportunity?
Gosh, this was the same question you asked me last time I was here, because when we were looking at the IWM rollover, and you said, well, what would change your mind? How would you know if you're wrong, or what would you like to see in order to invalidate this? And I said, honestly, I'd like to see ARK ETF. I'd like to see the IWM. I'd like to see the small caps actually start to come alive. And go figure, a couple weeks after we talked, they did. Yeah. So here we go. It's basically the same thing as far as the energy and oil sectors. I want to see them come back alive. You were just talking about, hey, is it over or under moving averages? Is the moving average up or down?
Yeah.
Is it making new highs or new higher lows? Like where is this going? And I think I don't trade energy too much, but I'm looking at Rig and Seadrill and some of those, and they're mostly going sideways, kind of, aren't they?
That's right.
Mostly sideways. And USO is kind of drifting a little bit lower, but not quite falling apart. So we might need to take the same tactic and say what we learned about the IWM, it didn't fall apart. That might mean it could actually be basing in a way, and maybe we should be aware of it moving back up. If we kind of step back and look at the whole picture about this stuff, and we say oil is a product of our economy and how we're doing, well, we were initially thinking, okay, we're going to get a recession. They're raising interest rates. Things are going to crunch and get tight. Well, energy and oil should go down. And in fact, if we really had a recession or, not a depression, but just a really hard crash landing, then you would imagine energy should also roll over because everyone's going to pucker up. But hey, maybe we're going to have a soft landing. I know it's got a bad connotation, but maybe something's going to happen. Maybe we're in this Goldilocks phase, and oil, energy, not falling off the face of the earth. It's starting to kind of settle. If it goes up, maybe that means that we're actually going to kind of emerge from this for a while.
There's a difference, I think, between a chart that's truly broken and something that's just sort of waiting and seeing mode. And I think crude oil could be one of those. We only have about 30 seconds left, but I'd love to think about a chart like Apple or some of these leadership names that have had such runs so far. Could you just briefly talk about how do you manage downside risk in something like that? Or what would tell you that a chart like this is no longer a good one to follow? Is it the Moxie indicator rotates lower? Is it a breakdown of a key moving average? What's sort of your go-to? This is something that I need to reconsider.
For something that has such a big move like this, the Moxie indicator might be appropriate, say, on the daily or hourly chart. We're not going to be seeing anything here on the monthly or weekly. The only thing I would kind of point to is, again, that third Keltner channel. You can see that Apple is really starting to bump up against that third ATR, those dotted lines at the top. And if you just look back, anytime it gets up in that area, there tends to be a pullback. So, I don't know if that's going to spell doom and gloom for the rest of the market, or if we can actually see rotation from large names like this, because if the small caps are starting to come alive. And if the economy does better, or at least the stock market does better, then, hey, people are going to realize that, yes, Apple was the safe haven. It was great, but it's not going to give us the 20, 50, 100, 200% returns that small caps will. So I imagine when the landscape gets a little bit better or continues to get better, we should see some rotation out of the mega caps because, again, 26% of the S&P is all in 5 stocks.
That's right.
So it can afford to take a little bit of money out of those and put it into the small caps. And that's where we're seeing IWM, Squarespace, IonQ, ON start to come alive.
Yeah. Great comments on small caps. That's a space we definitely need to keep watching. TG, listen, it's awesome to see you. Thanks for coming in the studio, and fly safe, all right?
Thanks. Always enjoy it.
That's TG Watkins. TG's the director of stocks at Simpler Trading here locally in Seattle. It's always a pleasure to have someone live in our studio, and we'll do it again here soon. But we've got to wrap this show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. You know, I'm talking yesterday about industrial stocks. I was scanning for names that were ranked highly using our StockCharts scooter rankings. Today, I was doing a similar analysis, just looking at the consumer discretionary sector. One of the top sectors today with the other FANG sectors, growth leadership that has continued to work. Why is the XLY doing so particularly well? 2 names make up about 50% of this ETF. And if you look, Home Depot is another big chunk as well. So those 3 names are pretty much the lion's share, over half of the weight in the ETF. Amazon making a new high for the year just this week. Tesla coming off a new high for the year as well, chopping around a little bit this week, but overall still in a position of strength. What's interesting is the equal-weighted consumer discretionary, which is RSPD. That's an equal-weighted consumer discretionary ETF, still below its February high. So while the XLY, Amazon, Tesla, all breaking out, could the equal-weighted version, not quite as much, but certainly improving in June. And when we talk about the improvement in breadth conditions, talk about how other stocks are starting to participate, I would be looking at something like the RSPD to see if that continues to move higher. That tells you that there's probably broader strength and not just the mega cap leadership in something like the XLY. Chart number 2, we've talked about breadth conditions and the strength that we've seen in breadth. I think the underwhelming breadth, last time TG and I talked in the studio, was absolutely true. And then things changed. Things started to really improve. I've seen signs of breadth becoming a little bit overheated. One of the tools we'll show you here is called the bullish percent index. And we've talked about this measure before. It uses point and figure charts as a way to measure breadth. What percent of stocks in a particular bucket, a particular universe, are showing a bullish point and figure setting? Just in the last week, it went above 70%. Now, overall, that's a good thing. That tells you that conditions are strong. But I've highlighted with a red vertical line every other time in the last 12 months, we've gone above 70% and come just right back below. It's similar to a stock becoming overbought using something like RSI and then coming out of that overbought region often lines up with a pullback. You can see previously there's usually been a decent pullback, a decent drawdown after that overwhelmingly positive breadth condition before we come down a little bit. Now, could it be the end of the world? Maybe, maybe not, but it tells you that we may be nearing the exhaustion here, or may have already reached the short-term top for something like the S&P and the NASDAQ. Finally, what do you think of chart number 3? Good long idea? Let's think about why. It's an ascending triangle, meaning we have a consistent resistance level. We have an ascending trend line connecting the lows. We're very close to a breakout. Maybe a break above 150 completes that bullish rotation. What do you think? Here's the thing. This is Chevron plotted upside down. So I'm basically charting the rotation lower and this potential topping pattern in Chevron, but plotting it inversely. That's a common technical trick to just invert the scale, kind of disconnect what you know about the company, what you know about the sector, and just focus on the trend. If you think this chart looks bullish, then you have to remember that the chart of Chevron does not look particularly good. This relative strength line going up is inverted as well. So on a relative basis, Chevron has been struggling in a big way. I would always much prefer being in stocks and ETFs that are outperforming than those that are underperforming. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Go to our YouTube channel for all of our previous interviews, some great special episodes as well. Thanks to TG Watkins of Simpler Trading here in Seattle joining us in the studio. For StockCharts in Redmond, Washington, I'm Dave Keller. Be well, stay safe. We'll see you tomorrow.